Welcome back, guys. Today we are doing an option strategy video. This will be part one of many to come in the future. And today's option strategy that we will be looking at today is called the covered call. So, what is the covered call and why is it a really good income generator? Well, in order to initiate a covered call, first we have to buy 100 shares of a stock that has the ability to sell options. So right here, I bought 100 shares right over here, 100 shares of Social Capital Hedosophia. So this is a SPAC that's going to merge with Clover Health. I believe in this company long term, so that's why I bought 100 shares, but I don't think the price will go up too much in the future, but I still have 100 shares. So what can I do to generate income and ensure that even if the price doesn't move or it goes down a little bit, I will be insured to get some sort of profit. So let's discuss why covered calls are very, very good, what can go wrong with covered calls, and which stocks you should put covered calls on. So let's look at the basics of covered calls. A covered call is basically there to boost income. That's one of the main reasons why you have covered calls. I mean, you can have 100 shares regardless, but if you sell a call, then you can get additional premium, which is credit to your account in order to guarantee to sell it at that strike price. So a covered call is a popular option strategy used to generate income from investors who think the stock price are unlikely to rise further in the near term. Let me give you an example. If an individual buys, 100 stocks of $10 each, that means that they spent $1,000, right? If they're not too confident with that purchase, rather than selling out and breaking even, they want to keep that $1,000 worth of shares because it can go up as well. So to ensure that they can keep the shares and generate some income, they might do something called a covered call, where they sell a future call. Maybe if it's a strike price of $12, which expires in, let's say today is the 5th of January, say if it expires on the 15th, right? And they collect uh, $100 of premium, right? So essentially what happens is that they sell the right to someone else to buy the stock at $12, right? And they collect $100 premium. So they get credited $100 into their buying power. So what essentially just happened? Essentially, they bought the shares for $1,000, right? And then they're giving the credit for someone else to purchase those shares at $12, and that expires in about 2 weeks, and they get $100 for that. So essentially, their total cost basis for their shares have gone from 1,000 down to $900 because they get credited $100 right over here. So why is this important? Well, if the stock were to go up and hit past $12, if we're to go past 12, right above $12, right over here, then we would see essentially they have a profit of around $300 plus. So why are you guaranteed $300 plus? Well, if you gave someone the right to have 100 shares at $12 each, then you are forced to sell at $12, right? So since your cost basis was 900 and you're selling for $12 each, that would be $1,200. You're guaranteed $300 there. However, if it were to go past, like 15, 16, $17, your max profit would still be $300. If it were to remain between $10 and $12, you would anything below $12, you would keep the profit, right? But the way you would start losing money is if the stock goes below $9. But you would have regardless lost that money if you didn't sell the call anyway. So I see this as a win-win-win situation. But this is mainly if you think the stock price will stay the same or go a little bit down. But if you think the stock can rocket up to 100% in 2 weeks, you should not sell a covered call because then you lose that max potential profit. So now let's look at an example at my Robinhood, and why I did it for that specific stock. So we're back here on Robinhood, and as you can see, I bought 100 shares at 15.05. So my total cost basis for my shares is $1,505. So I bought this around, 10:30, 10:40, but that's not the point. The point is that right after I bought my shares, I sold a covered call of 17 and a half dollars on January 15th. Right now it is, I believe it's January 5th, so I have 10 days. So why did I sell this call? Well, I did it for two reasons. One, I wanted to generate income. I didn't just want my $1,500 to not generate any income for me. Two, I wanted to lower my cost basis, which can be an and or situation. So essentially what's going to happen is going to be these three things that may happen, right? By January 15th, if this exceeds $17.05 per share, which I don't think it will, but it possibly can, because these SPACs are crazy. It's gone all the way up before. But if it does, then I will be forced to sell out because most of these options do get they do get exercised if it's above that strike price. But if it does, it would actually be my most ideal situation, because if it goes past 1750, I benefit around $350 because my cost basis is around $15 a share. So I got also $115, so my cost basis would be around $14 per share, a little under that. So 17.5 minus 14 is $3.5 per share, and I have 100 shares, so it'll be $350. Another situation can happen is that it can remain between my average cost, 1505, and between 17.5, which I do think is going to happen. So in that case, at the end of January 15th, if that does happen, then I get my premium for free. Essentially, I got $118, and I still have my 100 shares. So in these two situations, it really benefited me if I did the strategy. So you see, this is more than a 50% probability. But if it does go under 14 between below $13.90, which is our break even, understand that our break even in this situation would be our average cost basis minus the premium that we collected. I collected $115 premium, so 1,505 would be the share amount I spend, and $115 is what I sold it at, so that would be minus a 115. So that would be 0, carry the 9, 4. Sorry, that would be a 3 right over here. So my cost base is $13.90. If it goes below $13.90, I'm losing on this trade. However, I can just buy more shares at that point, because if I believe this company is a long-term hold, I will do covered calls on this. So the main point of covered calls is that if you want to generate income from not, very, very high flying stocks, you should do this strategy. I've done this strategy many times. It's been wildly successful for me, and I've generated a lot of income. But just keep this in mind. If it just blows past $17.50, that won't matter, because the max profit you can gain if it goes above $17.50 per stock would be your cost basis minus this. So again, your total profit would be only $350 rather than the full shares amount, because you do have that covered call there. So it minimizes your max profit, right, but lowers your minimum profit. So this is a very, very good strategy. If you think it's going to increase only a little bit and not reach the strike price, go down a little bit or stay the same, but you want to have your shares in the market. So I think this is the most powerful options out there, better than buying or buying calls or buying puts. I hope you did enjoy this video. If you want more videos like this, please leave a comment down below. If you would like to see more covered calls on certain stocks, I would like to see what you have in mind. Thank you for watching, and have a good day.